Good afternoon and welcome everybody to the Wednesday Lunchtime Drive-Thru on this September 9th of 2020. I am your cook for today. I'm always here at the Wednesday Lunchtime Drive-Thru counter. Damon King, I'm a certified financial planner professional and wealth management specialist with ChappelWood Financial Services. I'm also the lead instructor for ChappelWood University, which is our educational branch. Education is very important to us here at ChappelWood. It should be to you. And today, I'm going to give you an education in how to pay taxes like Warren Buffett. Now, you may remember, I always have trouble with the slides advancing. Okay, so you may remember a few years ago, the story came out where Warren Buffett was quoted as saying that he pays less in taxes than his secretary. He didn't actually say that, but that's what the story came out as. Warren Buffett pays less in taxes than his secretary. How can this be? How can it be that a billionaire is paying less in taxes than the person that he employs as his secretary, which I assume she wasn't making hundreds and hundreds of thousands of dollars as a secretary. Maybe she is. So here's the thing, all right? That headline is incorrect. The amount of tax, the dollar amount of tax that Warren Buffett pays is far greater than what his secretary was paying, far greater than what you or I are paying, all right? I'm assuming there are no billionaires on the call today. If there are, you should give me a call right now. Let's just stop everything, call me right now, okay? So the amount of tax in terms of dollars that he was paying was far greater than his secretary. What the stories should have said and what he himself said was that his tax rate was lower than his secretary. How is this possible? That's because Warren Buffett knows which income enjoys better tax treatment. When you know how the tax code works, you can bend it to your will. You can make it do what you want it to do. And that's the whole reason I teach all the courses that I teach. I get sick and tired of hearing people complain that the system is rigged and it's set up against us and nobody can get ahead. There are plenty of people getting ahead. There are 10 million millionaires in the United States right now, okay? The vast majority of them did not get there because they were born into wealth. They got there because they worked hard, first of all. They saved and they knew how to use things like the tax code to their benefit. So, how do most people pay tax? Most of us today probably pay tax through ordinary income. Ordinary income is taxed at ordinary income tax rates. These are the rates that you are very well aware of. The 15% tax bracket, the 22% tax bracket, the 24% tax bracket, 37, whatever, all right? That's called ordinary income tax. Things like your salary, W-2 income, your wages, whether it's W-2 or 1099, business income, all right? Retirement account distribution. So if you take money from your IRA, your pension, your teacher retirement, your TSP, your 403B, your 401k, your 457, all of those are tax deferred, so they are taxed at ordinary income tax rates when you pull them out of your account. Social Security, your Social Security benefit, if it is subject to tax, is going to be taxed at ordinary income tax rates. Most of the income sources that you have available to you are taxed as ordinary income, okay? Now, what is Warren Buffett doing differently than the rest of us? Warren, billionaire that he is, you see he's glowing right there. The aura is around him, right? The force is strong in him. Warren Buffett is focusing on income that enjoys lower tax rates. So while most income is taxed at ordinary income tax rate, not all income is. Some income is taxed at lower rates, things like qualified dividends that you earn from stocks. Not all stocks are dividend paying, but many are. And when those dividends come to you as income, they enjoy typically a lower tax rate. Things like long-term capital gains. So if you've held on to a stock for many, many years and you have a lot of gain, you've gained 30,000, 50,000, whatever, okay? I've got one client on this call today that has some stock and she's got a $70,000 gain in it. She's never going to sell it, but she's got a significant gain. If you have held on to a stock for a year and 1 day, Okay, so it's 1 year and 1 day, not a year, 1 year and 1 day. And you've owned that same stock, that is considered long term. If you then sell that stock and you have a gain, and the gain is whatever you sold it for minus what you paid for it. Anything above that is gain, taxable gain. If it's long term, it's going to enjoy a lower tax rate. And then you've got things like municipal bonds. So bonds, like anything, issued by a municipality, like a city or a state, something like that, those are federally tax exempt. So these are all types of assets that enjoy lower tax rates. And Warren Buffett owns all these. He also harvests losses where it's possible. So you can actually harvest a capital loss. You get taxed on a capital gain, but if you have a loss, you sell something at a loss, you get less for it than what you paid, you can use those losses to offset gains. None of this is illegal. We're not talking about tax evasion. We're talking about tax avoidance, tax reduction. That is completely legal. And guess what? Anybody can do it. It isn't just reserved for the super rich. Anybody can do it. So what are these magical tax rates? Well, let's take a look. Qualified dividends. For most of you, it's going to be 15%. That's what you're going to pay on dividend, 15%. If you're in the top tax bracket, which right now is 37%, then your dividend rate is going to be 20%, okay? What about long-term capital gains? Again, 15% for most of you, 20% if you're in the top tax bracket of 37%. Municipal bonds, again, federally tax exempt. Doesn't matter what your tax bracket is, the income from municipal bonds under current law is federally tax exempt. The reason that Warren Buffett's effective tax rate is lower than all of us, almost all of us, is because most, if not all, of his income is from these sources. He does not have W-2 income that is taxed at ordinary income rate. He does not have wages, okay? Now, he might get some income, I guess, from his real estate business, Berkshire Hathaway, that will do real estate. But the vast majority of Warren Buffett's income comes from these tax-advantaged assets, dividends from stocks, long-term capital gains, municipal bonds, all right? That's what he's using. That's how he keeps his tax rate lower. So how about an example? Let's say Warren earns $1 million, all right? Now, if he paid ordinary income, he'd be at the top tax rate, which is 37%, and he would pay $370,000 in tax. Now, I should tell you that it's not exactly $370,000 because there would be deductions and credits. And keep in mind, the tax rates are progressive. So not all 1 million is taxed at $37,000 or 37%. A certain amount of it is taxed at 10%, and then the next is taxed at this, and the next. So it goes progressively. That's why we call our tax system a progressive tax. The more income you have, you progress up the ladder of tax rates, okay? But for purposes, make it simple, keep the math simple, $370,000 in tax. Now, let's say that instead of that $1 million coming from W-2 income, which is ordinary income tax, let's say that he's earning all of that from dividends, all $1 million from dividends, okay? Well, he's going to pay a 20% rate because $1 million is at the top tax rate, right? All right, so he is going to pay the 20% rate plus an additional 3.8% tax called the net investment income tax. Now, the NIT, or the net investment income tax, is an additional surcharge tax that higher earning individuals pay when they have a lot of unearned income or investment income from dividends, capital gains, things like that. So you add those two things together, even at the top rate, Warren Buffett is paying a rate of 23.8%, which is lower than 5 out of the 7 tax brackets that we currently have. Okay? There are only 2 that are lower than his current tax rate. That's astounding, isn't it? Isn't that amazing? That Warren Buffett, one of the richest men on the planet, one of the greatest living, if not the greatest living investor, has found a way to make his tax rate lower than 5 of the tax brackets, lower than probably your tax rate. He does it because he uses tax advantaged assets. Now, over 10 years, Warren is going to save $1,320,000 in tax payments. What do you think he could do with that money? He could reinvest it. He could go out and buy another business, go buy some more real estate. Imagine what you could do with that kind of money over that period of time. All right. The power of tax avoidance and tax reduction cannot be overstated. All right. Now, how about an example for you? Let's bring this back to you and me. All right. Kind of normal life. All right. So here's option one. Let's say that you earn $300,000 this year and you pay, and it's all wages, all salary, ordinary income tax. So depending upon whether you file a joint tax return or a single tax return, you're going to pay tax anywhere from 24 to 35%. Okay. But option two, let's say that instead of all 300,000 of that being ordinary income tax, let's say that half of it comes from ordinary income tax. So if you're retired, let's say it's coming from a pension that you receive and Social Security and different places. But the other half of your income comes from qualified dividends, long-term capital gain harvesting, municipal bonds, investment income. All right. That, for the most part, is going to be taxed at 15%. What have you done here? Number one, you have totally lowered the tax you're going to pay on half of that from 24 to 35 down to 15%, but you've also lowered your overall tax bracket because the ordinary income tax that you have is at the lower tax rates. All right. That's what you've done here by building in some of this tax advantaged income into your portfolio. Now, I'm going to show you how you can do this here in just a second, but the potential tax savings you're looking at, if you file a joint tax return, saving in 1 year about $16,000, almost $17,000. If you are a single tax filer where the tax rates, the brackets are more compressed, you're looking at saving upwards of $46,000 if you were able to build in tax advantaged income to your portfolio. Now, some of you on the call today are clients of ChappelWood, or I know for a fact that you derive some of your income from these sources. So you're already practicing good tax efficient income cash flow management, all right? But if you don't currently have these assets, or even if you do and you want to know how do I continue to do this? Well, first of all, how do you own tax advantaged assets? Well, the first thing you want to do is you want to own these tax advantaged assets inside of a taxable account. So if you have a brokerage account, investment account, or it's a TOD account, transfer on death, or you own a trust account, or it's a joint account with you and your spouse or someone else, any investment account that you receive a 1099 for every year for the interest that you earn, you want to own these tax advantaged assets in those kinds of accounts, because the dividends, the long-term capital gains, the municipal bonds are all going to serve to lower your overall tax bill because they are tax advantaged. You're looking at 15%, 20% at a maximum. In the case of municipal bonds, no tax at all. You can also use those taxable accounts to harvest losses. So if you've got a bunch of capital gains, you're going to have to pay taxes on those gains, right? But if you have losses, especially in a year like this, right? Maybe you've got some stocks in your portfolio that you were probably going to sell anyway, but since the beginning of the year, they had a major loss and they still haven't completely recovered. We were actually harvesting losses for our clients way back at the beginning of the year when the market tanked. So stocks that we were probably going to get rid of anyway, it was a great time to harvest those losses, which we can now use to offset some of the pretty significant gains we've gotten in the market. You want to use these tax efficient investment strategies inside of a taxable account. Now, you want to hold your ordinary income vehicles inside your tax deferred accounts. All right. So things like corporate bonds. Corporate bonds, when they pay income out, they're not tax advantaged. They are taxed at ordinary income tax rates. So you want to hold those kinds of assets, or short-term capital gains, which are taxed at ordinary income tax rates. Hold those kinds of assets inside your tax deferred accounts, because even when you get that income, you don't pay the tax every year. You only pay the tax when the money is pulled out, right? So This is one of the things that your advisor can help you with, holding different kinds of assets in the right accounts based upon their tax efficiency, their tax status. This is how Warren Buffett keeps his tax rate lower than yours. You can do this too. All right. So benefits of tax advantaged assets. Well, duh, lower taxes first, right? But also, if you've heard me in any of my classes and you've listened to our radio show at all, you've heard me say that your Social Security benefit can be taxed, and the amount of tax you pay is going to be based upon your other taxable income. Up to 85% of your Social Security benefit can be taxed. It can be very difficult to stay below the threshold because the more income you have, the more your Social Security can be taxed. Those income thresholds are not that high. Okay, you're talking, at the most around $40,000 a year, something like that. You probably want to live on more money than that. So if you cannot completely avoid taxing your Social Security, what that means is you need to find tax savings in other ways. Using these tax advantaged assets is one way to do that. Again, if you have any questions during any of this presentation, I'll give you a chance to ask questions at the end. But if you have a question or comment through any of this, please hit the Q&A button in your toolbar, and I will be very happy to answer your question here live. Also, having these tax advantaged assets, first of all, they generate income. Income is what you need in retirement, right? You got to replace that paycheck. So these kinds of assets provide income and they lower taxes, both of which you need in retirement. Because what are the two areas of vulnerability you have in retirement? Number one, you don't have a guaranteed paycheck anymore, so you need income. And number two, since you don't have a guaranteed paycheck, you are least likely or least able to pay taxes. All right? Only when you have guaranteed income coming in that you know is going to be there are you better able to pay taxes. So typically in retirement, when you have voluntarily chosen unemployment, you are least able to pay taxes. These kinds of assets help with that. So a good mix of tax deferred and tax advantaged assets is what you need for good cash flow management. The ability to minimize your tax bill is largely going to be predicated on your ability to manage the flow of cash from different accounts. If all of your money that you have saved your entire life is held inside of a tax deferred account, again, a 401k, a 403b, and I'm assuming it's not a Roth. If it's just a straight up traditional 401k, 403b, TSP, IRA, a pension, those are all tax deferred vehicles. And if all your income comes from there, then all of your income will be taxable. There's no chance, no opportunity to reduce taxes otherwise. So what you want to do is make sure that you build in, as you are saving money, build in other buckets of money that can enjoy more favorable tax rates later on down the road. Whether you are contributing to a Roth account or you're contributing to a taxable account. Will you have to pay taxes every year? You'll get a 1099. But if you practice paying taxes the way Warren Buffett does, overall, long-term, you'll keep your tax bill much lower, okay? Now, some other things to consider. I just said a version of this. Don't get addicted to tax deferral. Tax deferral sounds great. We all love tax deferral. We all love putting money into our 401k, and it reduces our taxable income. And then at the end of the year, you get this wonderful refund, which you go out and you spend on other stuff. Don't get addicted to tax deferral, because tax deferral is a double-edged sword, all right? It's tax deferral, not tax avoidance. You have to pay the tax eventually. So you have to consider, is the deduction that you get today, is it worth the long-term future of no or lower taxes? I don't know. I mean, for me personally, the tax deduction I get for contributing to my traditional IRA today is not worth nearly as much as investing after-tax dollars in a Roth account and then having tax-free growth for the next 20 years. Okay? to me, the deduction that I get today is not worth the long term. It's all dependent upon your situation. But don't get addicted to tax deferral, because eventually it will come back to haunt you. It will come back to bite you. I like to leave myself many ways to generate income, and be prepared to pivot if the tax laws change. If Joe Biden gets elected, we talked about this last week, the difference between the Biden and Trump tax plans. If Trump gets reelected, not a lot's going to change. But if Biden gets elected, over time, there are going to be some significant changes potentially to the tax code. But when the tax code changes, don't complain about it. Let other people complain. Oh, the tax code, I have to pay too much in taxes. The system's against me. I can't get ahead. Don't be a complainer. Find out a way to use the system to your advantage. Educate yourself just like you are today. Learn how it works. Okay? Do I like paying taxes? No. But it is the system we have. So you know what I'm going to do? I'm going to say, I'm going to learn how it works. I'm going to know how the system works. And if I know how the system works, I can use it to my advantage. That's what you can do. Anybody can do this. All right. So what questions can I answer? Are there any questions that anybody has about whether it's Warren Buffett's strategy for generating tax efficient income? Are there other tax questions? Okay, we do have a question coming in here. Is there any way to invest more than 7,000 in your, and I'm assuming, Deanna, this is from Deanna, you're probably going to say your IRA. Oh, and your Roth. Okay. So again, you're talking about an IRA. Right now, there is not. Okay. The most you can contribute to an IRA this year actually is, yeah, I think it's either 7,065. Yeah. That's the most that you can contribute, okay? And keep in mind, you asked about a Roth, Deanna. First of all, to contribute to an IRA at all, you have to have earned income. All right, now, Deanna, I know you're working, and I know many of you are working. So if you do have earned income from a job, you can contribute to a Roth or to an IRA. However, if your income is too high, meaning close to $200,000 if you file a joint return. I can't remember the number if you file a single return, but the ability to contribute to a Roth is limited based upon your income. Higher income amounts, you get phased out from being able to contribute to a Roth account. Your only option is to contribute to a traditional account. Now, there is another option called a backdoor Roth conversion. All right. So let's say that you're someone who you want to get money into a Roth IRA, but you cannot because your income prohibits you from contributing to the Roth. One thing that you can do is you can make a contribution to a non-deductible traditional IRA, all right? Meaning contribute to a traditional IRA, but you don't take the deduction for it like you ordinarily would. Why is this important? Because if you take a deduction today, what does that mean? You're going to have to pay the tax later. If you don't take the deduction today, it's considered an after-tax contribution, even though it's in a traditional IRA. Then what you're going to do is immediately convert that to a Roth IRA. There's no restriction, there's no income restriction on converting from traditional to Roth. So if you convert the non-deductible traditional IRA to a Roth, and typically you can do this on the same day. That way there's no growth. If there's no growth, you will not be taxed on the conversion like you ordinarily would. Now, that is the basic way that the backdoor Roth conversion works. But you have to still be careful with it, because this is a loophole that Congress has kind of sort of tried to close. And it's called the pro rata rule. Now, I'm not going to get into all this today. I'm going to tell you about it, and you can go look it up if you want to. Or we can have a conversation offline. But if you do that, the pro rata rule says, we're going to take a look at your tax deferred money, how much you had, and we're going to assume that you moved it from a tax deferred account to a Roth, and we're going to go ahead and charge you tax for what you should have paid with a normal conversion, but it's as a percentage of your total. I know that's kind of convoluted, but I wanted you to know that there is a way for high income earners to contribute to a Roth, but it's indirect. There still could be some tax consequences there, but you want to work with your tax professional to see, does it make sense for you? So that is a good question, Deanna. Thank you so much. But you are limited to what you can contribute to an IRA in any given year. You're not limited to how much you want to convert from traditional to Roth, if that's what you want to do. All right, got just a few more minutes here. Any other questions from anybody? Any comments? Any questions about how Social Security is taxed? Anything like that? While you're thinking of your questions, because I know you probably have them, I do want to invite you to my next class. So I have a lot more to share with you. So these quick 30-minute classes are great for middle of the day, but if you really want to go more in depth on taxes, income planning, Social Security, Medicare, estate planning, healthcare planning, all that stuff, I really encourage you to enroll in our Rocket Retirement course. Many of you have already been through that course. Some of you have been through it multiple times. If you've never been through it, this is 4 hours of education over 2 nights, totally online for the rest of 2020 because we're still in the grips of the virus and nobody wants to be around each other and all that. The university is closed or I can't get into the university. So it's all online, comfort of your own home. And it's also free for the rest of 2020. We're going to cover all those areas of retirement planning, how not to run out of money, how to lower your tax bill, how to build an investment portfolio to generate income for you, which is what you need in retirement. What is Medicare all about? What are your options? And what's the difference between a will and a trust? And what are some other things you should have in your estate plan? We provide the course workbook. We email it to you. It's totally online. You can go follow along. And I share the workbook on the screen during the class. Our next class is coming up September 17th and 24th. So that's a week from tomorrow, next Thursday. Again, all you have to do to get enrolled in this class, visit ChappelWood U for ChappelWood University, ChappelWoodU.com, and you'll see over on the right-hand side of the page, you can click the September class, get enrolled, answer a few questions, and then you're in. You'll get a confirmation that you're enrolled in the class, and I will make sure that you get the workbook right before the class begins. Let's see, one last check to see if we've got any other questions. I don't see any questions at the present time. I'll hang out for just another minute or so if anybody has any questions, but we are finished for today. I want to thank you so much for joining us for the Wednesday Lunchtime Drive-Thru today. Tell other people about it. I'll get them enrolled. You can share the link that you have gotten before to enroll, but don't share your own link to get on the Zoom meeting. If you know someone that would love to participate in these, let me know. Email me at damon@chappelwood.com, D-A-M-O-N @chappelwood.com. And I'll be happy to send the registration link for the Wednesday Lunchtime Drive-Thru. Of course, your spot is reserved for the rest of 2020. So thank you so much for being on the call today. I hope you have a great day. Stay safe, enjoy the cooler weather. And here is to rocking your retirement and keeping more of your money in your pocket and out of Uncle Sam's. I'll talk to you soon. Bye-bye.